Hey guys, Taylor with GammaEdge here, coming at you with another education piece, and today we're going to be talking about covered calls. So we're not going to be necessarily talking about how to identify cover call candidates, right? That can be up to your individual process, but what we're going to go through is how to use the GammaEdge tools to help you understand where to be effectively selling those cover call positions. And we'll go through it in an actual example as well. Right, so starting out, you've been selling cover calls for months or maybe even years. Hint your interest in this article or this video. You have a pretty good system, right? You may be picking, strikes 5 to 10% out of the money, maybe following the 45-day rule, collecting premium and repeating. Maybe working for you, you could be generating a steady stream of income against your long-term holdings, but what if there was a way that you could be even better at it? Here's something that you may or may not have realized. You can leverage the options markets to understand where profit-taking pressures naturally occur. So while you may be focusing just simply on time decay of the call options that you've sold in arbitrary strike selection, there's an entire layer of market intelligence, i.e., through understanding of the positioning within the options markets that you can and should be using given modern market structure today that can help you better pick strikes where natural resistance exists. For the avoidance of doubt, we're not talking about replacing your existing strategy, right? If 45-day approach works for you, if picking 10% out of the money always works for you, you should keep on doing that. What we are simply wanting to present to you today is a way to enhance your strike selection by understanding where call speculator concentration exists in the option structure of the particular equity that you're looking at. And as we'll get to, the reason you want to focus on these levels is because this is where natural monetization occurs. And when that occurs, it kind of creates a natural resistance level, which is a great way to understand where that level is so you can be selling premium with that key kind of reference level as a reference point. And again, the market doesn't necessarily care about, where you're selling based on a percentage, like 5 or 10%. Doesn't really care about that, right? It makes a lot more sense to us, at least, to be understanding and evaluating market structure in terms of where folks are actually positioned that could create these natural selling points. So getting into the immediate meat of it, need to get into a bit more theory, and then we'll get into an actual example to kind of bring it home for you. So right, as we were saying in the introduction, option market consistently signals where profit taking is most likely to occur. You just need to know where to look. And that is where plus GEX comes in, which is a proprietary level of GammaEdge and probably the most powerful level in our entire toolkit. And if you're wondering, plus GEX stands for positive gamma exposure and represents the strike within the structure that contains the highest concentration of call gamma. Or think of this way, it's the price level in the options chains where the most short-term call speculation is concentrated, right? And plus GEX just isn't a random data point. As I said, it's one of the most important levels in the GammaEdge kind of ecosystem because it's where human psychology kicks in. So a little bit of an example for you. So when traders buy out-of-the-money calls, they're risking the premium they paid for the potential of significant profits. Say the stock trades at 100, plus GEX sits at 120. So right, that means that those call buyers are targeting 120 as their key profit level. This is kind of where the maximum benefit of that position occurs. And by this we mean, once it hits 120, their target level has hit, and this is where maximum convexity of that position occurs. So right, convexity means that there's been a rapid price appreciation as they move from out of the money to now at the money to in the money. And right, human nature kicks in that they likely want to, lock in those gains. And this is what we refer to as those monetization zones. And so again, just summing it up, plus GEX, where the maximum short-term call speculation occurs in the structure. Once we're approaching that level, those contracts have had a rapid appreciation in price, and this creates kind of natural monetization zones, which creates natural selling pressure. Right, and specific to covered call sellers, the reason we went into that for plus GEX is that it provides you with an understanding of where selling pressure is likely to emerge, right? Because now rather than just picking some, arbitrary random strike that may or may not have any significance into, the actual movement of price, now we are looking at the actual positioning of speculators by looking under the hood through the options markets to understand kind of where they're piled in at and where profits could be taken. Right, and that this pretty much says the same. Traditional approach may tell you to just sell 10% out of the money because that's what works. However, using plus Gex approach, it tells you, where speculative positioning already could create that resistance, right? And now we're leveraging and kind of working with market forces rather than against them, right? And just an important note that we want to make, kind of a key differentiation is, GammaEdge's plus Gex is most potent. Let me rephrase that. Plus Gex is more potent than simply looking at the strike with the highest call open interest and the option structure. The reason for this is because plus Gex incorporates gamma, which is the element of time. And again, gamma is what plus Gex is predicated on. Right, so a strike with massive call open interest expiring 6 months from now has minimal impact on today's price action. Right, plus Gex, which is based off of where gamma is highest, emphasizes near-term options. And these are the positions that actually influence current price movement and creates immediate profit-taking pressure. So now that we kind of have an understanding of, using the options markets to help us sell these covered calls, using plus Gex, kind of understanding what that is, why it's important. The next concept that we want to cover on is something called path dependency. And by path dependency, what we mean is, say that you're wanting to sell 45 days out. So you may go look at that expiration to understand where plus Gex is, kind of around that 45-day window. But something important to know is that there's expirations between now and that 45-day window, and that's what creates the path dependency, right? Your success doesn't just depend on where the stock ends up at expiration. It depends on the journey it takes to get there, right? So a simple metaphor for you, you're planning on taking a trip from New York to Boston. You could take the highway straight through if you're so lucky, or you could encounter construction zones, traffic jams, and detours along the way. The destination is ultimately the same, but the path dramatically affects this same logic applies to covered calls. Between today and your target expiration date, there are multiple weekly and monthly expirations, each of which with their own plus Gex levels. This creates a series of potential speed bumps or acceleration zones that could help or hurt your position and your overall thesis on the stock. Right, so quickly, if you're not familiar with options expirations, there are monthly and there are weekly expirations. Monthly expirations typically have the most robust open interest and create the strongest plus Gex signals. These are your major destinations. Reliable structural levels where significant profit taking observes. Monthly expirations are normally the third Friday of each month. And in between those monthlies, there are weekly expirations as well that have their own plus Gex levels, right? But the key thing is that these are often weaker and can be misleading. Weaker meaning, there's not as much option, open interest, liquidity, etc. in those expirations as there are in the monthly expirations. Right, just a quick example for you so you can visualize that. This is our web app. Here we're looking at Apple. You can see that we have 5.5 million total open interest right now. Now, if we drill into just 9/19, which is a monthly expiration, you can see we almost have 1 million open interest. However, the week after that, which is just a normal weekly expiration, 110,000. And then the week after that, you have 66,000. So you can see how there's a dramatic decrease in total open interest, right? Right, and so going back to the weekly expiration, think of these as potential potholes in your path. Sometimes they matter, sometimes they don't. Right, unfortunately, trading is not black and white. There's a lot of gray that we have to navigate. Right, and the key insight from all this is that the arrangement of these plus Gex levels between now and your target expiration determines whether structural forces are working with you or against you. Right, and so if shorter dated plus Gex levels create stepping stones below your strike, meaning say the stock is trading at 100, you're selling the 140s, and all the plus Gex levels between now and your expirations are below 140. These are the stepping stones, but each one becomes a profit-taking zone that supports your position. However, if all the plus Gex levels sit above your strike, they suggest upward pressure that could lead to early assignment. This is what we call path analysis, right? Path dependency, mapping out the structural obstacles and opportunities between today and your expiration date. So, right, we're going to kind of go through those two scenarios again, just with theoretical examples, then we'll get into an actual examples and wrap up the lesson. So scenario one, which is the favorable path structure, right? Your strategy calls for selling 45-day calls. Current stock price is 100. The favorable path looks like this. So today 100, next week's plus Gex 105, 2 weeks from now 107, 3 weeks from now 108, and then the monthly expiration is 110, right? Plus Gex your target. You can see how every plus Gex from now till your expiration is below the 110 target. And that's pretty much just what I said here. So, right, creating stepping stones of natural resistance that should slow the advance towards your strike. So, right, in terms of strategy, selling calls slightly above the ultimate plus gex target of 110. So that give me 112, 115, 120. Right, and so you are positioned just slightly above where the strongest resistance is kind of set in the structure. That should, right, helping to kind of have natural resistance. And right, the stepping stone levels give you confidence that upward pressure will face multiple resistance points before reaching your strike. Right, next structure is scenario is the more challenging path. Right, again, just using all the same things. 100 is your target. 110 is ultimately your plus gex target. However, we can see weeks 1 through 3 where their plus gex levels are all above our kind of ultimate target, which is the monthly expiration. Right, and when this happens, what its suggestion is upward price, biased to the upside in the near term, higher probability of early assignment, right? Because the natural selling pressure is occurring above kind of your target end of the monthly strike. So in terms of your adjusting your strategy when this happens, consider avoiding this setup entirely, right? The structure is working against you. So, if you must trade, use more conservative strikes well above the call speculation, maybe, 125 rather than the 112, 115 we were saying earlier. Right, but ultimately you need to recognize that this challenging structure suggests that the stock wants to move higher. Right, so just recapping the lesson up until this point, this last part. So we've gone through why, wanting to incorporate, looking under the hood through the position in the options market makes sense for selling covered calls. We've gone through plus gex, the importance of plus gex. We've gone through the two scenarios, scenario 1, scenario 2. And now let's get into a real example with mapping out Palantir. Keep in mind this example is from the end of August of 2025, so not necessarily relevant to when you're watching this video, which is after that date, but still the examples and the lessons from this example are going to be evergreen through the end of time. So you're interested in selling Palantir call in the September monthly expiration, about 3 weeks out. To map this properly, analyze all expirations between now and then. So we have the 9/5 weekly, we have the 9/12 weekly, and we have the 9/19 monthly. So first off, what we're going to do is we're going to look at all three of those expirations together, just to get the bigger picture of kind of where we are positioned. So when looking at all expirations combined, plus gex sits at 165, or about 5.6% above the closing price from 829. The closing price from 829 looks like 156, 158 or so. Now let's go through the path to printancy to understand what plus gex looks like from now until our monthly expiration. So looking at the 9/5, this is the first weekly expiration. Plus gex drops to 160, so that is good. This tells us the first speed bump sits below the 165 kind of ultimate target that we had. So that's good. Then, moving on to 9/12 and 9/19 combined, seeing what those look like. The remaining two expirations, so it significantly dropping down to 140, which is well below the current spot price. This means that long-term call speculators are already well in the money and could be monetizing those positions, creating selling pressure. Again, this would support selling the 160, 165 todays as we expect price to move sideways to lower. Right, and looking at the final destination, which was the 9/19 monthly expiration. Here again, plus gex sitting at 140, confirming that the dominated call speculation sits well below the target kind of upside strike. So looking at the strategic decision and what that path analysis reveals for kind of a favorable setup for our cover call sellers. So we have near-term resistance at 160 in the first week, which may help to slow the advance. Long-term structure suggests, selling pressure from the in-the-money calls, right? Specifically the 140 strike, those being monetized. And then strike selection, the 165 or higher calls look attractive, positioned above the immediate term resistance, but benefiting from the overall structural headwinds. Right, so instead of just blindly selling covered calls, at some set percentage out of the money, this analysis or kind of way of thinking shows you why strikes around the 165, 170 level makes sense. Right, and so you're leveraging the options market and the significant positioning within to help position yourself above a near-term resistance with longer-term forces working in your favor. Right. And so if this piques your interest, kind of curious how to better implement this into your process, here's just a quick little workflow for you. So in the morning, basically you're just going to pull up the web app dashboard. Again, that's what this is. You can type in any ticker you want to. Keep in mind the option needs to have significant adequate volume liquidity for this to be relevant. If options are not meaningful for an underlying, then this analysis is not necessarily meaningful. And right, you're just going to navigate to the stock you're interested in, look at the plus GEX levels around all relevant expirations that you're looking at. And right, the dashboard makes it very easy just to click through one at a time, group them up, whatever, look at them all that good stuff. And then simply note where the current stock price is relative to these levels. And then next is mapping out the path. So identify the plus GEX levels on the weekly, bi-weekly, monthly expirations from now until your target expiration. Determine if you have a stepping stones path, right, where the plus GEX levels are below the ultimate target, or if it's going to be more of a challenging path where those plus GEX levels are extending above your target, right? And then remember, ultimately, the monthly expirations typically provide us with the most reliable signals. And then going through the different types of setups, right? Green light structure, is where the plus GEX levels are below your target, creating that stepping stone. We have the yellow light where you have some plus GEX levels above, some below. That's where you want to be a bit more conservative and give yourself extra cushion. And you want to be monitoring this. The red light, most are probably plus GEX levels are above your target, considering just avoiding this altogether. And then, plan for quick exits if you kind of get a rapid price appreciation. A couple common questions and concerns that we often get, a few objections for you. So this seems too complicated for covered calls, right? I get it. Covered call is supposed to be a very simple strategy. And you're already doing a lot of the work, right? You're analyzing which stock to pick and you're looking at kind of the strikes and expirations that you want to sell. So you're already doing, 99% of the work. Now you're simply just adding one layer, which we make it super easy for you to do, which you're just going to the dashboard quickly to understand, okay, is positioning, does that make sense with what I want to be doing here? Right. And, as a simple analogy, it's like checking the weather before leaving the house. You don't need to become a meteorologist, but you can simply just look to see if it's going to rain or not to make a better decision. If you should bring a jacket, you should bring an umbrella, all that good stuff. The core workflow takes you like less than 10 minutes, right? It took me 2 seconds to just run through this really quick. Next one, what if plus GEX levels are wrong? And by wrong, what if, price blows through these levels? Because the plus GEX level can never be wrong because it is just math. So it's more like, what if the market doesn't respect the plus GEX levels? And right, these are not predictions about what will definitely happen. They're just probabilities, right? No guarantee. As I said earlier, markets are not black and white. They are gray. And simply what we want to be doing is using all the information available to us to stack the probabilities in our favor. Right, but the one benefit of these levels is that they're based on real money from real traders. When thousands of call buyers position themselves at a specific price, it creates a genuine supply and demand dynamic that traditional analysis can't see. Right, and the beauty of this is even when price levels fail, that is key information, right? A key early warning sign. It tells you, something important about the strength of the move. So another thing we get is, my broker doesn't provide these tools. And so that's kind of like, duh, it makes sense because this is something that we've created and why we think our platform is valuable to you. Right. And, we built these tools because most retail platforms, retail traders don't have access into kind of this depth of options analysis. And so again, that's why you can access our web app. You can access the Discord bots to generate these levels for your trading to make ultimately better, more informed decisions. And then lastly, what about earnings and news events? Right. And, major news events like these can certainly overwhelm structural levels. Earnings announcements, Fed decisions, company specific news, price can certainly blow through, plus GEX resistance. It's impossible to say how something is going to react to a major news event. And if, someone is, guaranteeing you that they do, I would probably run for the hills. We just wanted to be transparent about that, but that's where position sizing and risk management becomes critical. During those high volatility periods or, periods where there's a lot of uncertainty, reduce position sizing across the boards, using more conservative strikes, or avoiding positions entirely around these major news events. Right, and just for the avoidance of doubt, this structural approach works better in normal market conditions, not during major disruptions. And so, coming to the end of this article, I know we're running up on 20 minutes here. The power of this methodology comes from understanding human behavior at scale. When you sell a covered call, you're not just betting against one person, you're positioning yourself relative to thousands of traders who's made similar bets. Traditional approaches tell you to focus on time and probability. They'll tell you that options X days out of the money have a Y chance of expiring worthless based off historical patterns. The GammaEdge structural approach focuses on actual positioning and psychology. It shows you where real traders have placed real money and where their natural profit-taking behavior will create resistance. And again, this isn't about replacing sound principles like time decay and probabilities. It's about adding, market intelligence through understanding of option market positioning that helps you apply these principles more effectively. As you start to study this approach that we just gone through and ultimately implement it over time, you're going to have better strike selection, right? Because instead of just arbitrarily selecting percentages, you're choosing based off of positioning and where natural resistance exists. That's going to give you higher confidence in your trading because you're removing the guesswork and you are having more strategic positioning, right? And from here, right before changing anything, especially like if this is a very successful strategy for you, you simply just want to start by observing. Spend time tracking plus X levels with your existing positions and ones that you're considering. Again, we're not telling you to become a different trader overnight. It's about becoming a better version of the trader that you already are. One who understands the structural forces that most market participants never see because they don't pay attention to the options market, which has significantly grown over the past decade and is pretty influential in moving markets on a day-to-day basis. Right. And the goal is simple, transforming you from someone who's hoping your strike doesn't get hit because, right, hope is not a risk management strategy, to someone who understands market forces that determine whether they will or they won't. So, start small, stay consistent, and let market structure guide you towards better cover call results. Your future self is going to thank you for, taking the time and adding this additional layer of, market intelligence to your trading toolkit. So with that, that's all I got for you guys with covered calls. Appreciate the time, and we'll catch you in the next one. Thank you. Bye.